Hey, this is Ken at Capital Advantage Tutoring, and I'm doing this. I have a regular podcast on blue collar finance, but I'm going to start doing these on YouTube because I figure why not. So this is going to be a very high level, very long, but very high level intro to the SIE. I'll have other breakout ones with better. Sound isn't awesome, but you're going to learn a lot. It's about 3 hours long. It should drive you nuts. I'm going to try to put chapters on it, but maybe I won't. Who knows? Just watch it, try to get the high level stuff, and we'll have breakouts on different stuff as we go along in the year. Let's go, baby. Okay. So let's start with the first thing. I'm going to start with the different acts. So there are 4 or 5 acts we have to worry about. The first act is the Act of 1933. And remember, don't worry about notes as much as, because remember, this is all being recorded, but notes are good. The Act of 1933 it's the first act, so it's the primary act. So it's going to be all about the primary market. What's the primary market? That's the main reason for Wall Street. So think about it. All the stuff we did, trading and selling products and pushing other stuff, are all secondary to the real reason for Wall Street. The main reason for Wall Street is to raise money for companies. That's what we're doing. That's the primary reason. We're trying to raise capital. Like if you ever watch Shark Tank and stuff like that, that's where, the person's pitching an idea and hopefully one of the sharks says, oh, that's a good idea. I'm going to give you money. That's literally what we're doing. Okay, when we're raising money different ways. Like Mark Cuban and Lori and all of them, they will give you money for equity, and then Mr. Wonderful always wants to give you debt. So it's literally the same sort of stuff. So the Act of 33 is raising money. So when we first start that, if we want to raise money, we have to register it with the SEC or someone. It's most likely the SEC unless it's exempt. So if we want to raise money for the first time, we're going to file a registration statement with the SEC. Does anyone know what that starts? What starts after you file the registration statement? Bueller? They always tell me to wait 7 seconds after I ask a question, because that gives somebody enough time to get the guts to say something. So does anyone know what, after you file the registration statement with the SEC, what then happens? Oh, let me turn my speaker up. I think somebody said it.
A waiting period?
Yes. How long?
20.
I love it. 20 days. So after the end of the 20 days, the SEC approves you, right? No, they don't approve. No regulator ever approves anything ever. So they just declare you effective, hopefully. Remember that. No regulator ever approves anything ever. So they would declare you effective. So after the 20-day review, where you can't really talk about the company too much, they will declare it effective, hopefully, unless they find something wrong. But during this 20 days, you can market the thing a little bit. So the first thing you do is you file your registration statement. Then you start gathering IOIs, indications of interest. An indication of interest is you just reach out and go, hey, are you interested? And they go yes or no. It's not binding on anyone. And how do you do this? By sending out what they call a red herring or preliminary prospectus. That is literally the prospectus without the date and time. It's just preliminary. It is not considered advertising. It is just, hey, this is all the disclosures about the firm that we're raising money in, how much we're going to raise, about how many shares we're going to issue, what we do, what our past financials are, who the officers are, stuff like that. Then you send that to them. You get the indications of interest, which isn't binding, and then you try to register it in the various states, called blue skying the issue. We're blue skying. Okay? Blue sky always means state rules, so you might see a reference to blue sky, know that it means state rules, and that's covered by NASA, NASAA. That's the regulator. That's the group that writes the rules. Now, after that, we can then do what they call a due diligence meeting, where all the accountants and the lawyers and all that get together, and the underwriters. Now, understand something. Let me go through this. Accountants and lawyers, you can figure out what they do. An underwriter is a broker-dealer. That's their job. They create a syndicate of other broker-dealers. So let's say New York Life is the lead underwriter to take my company public. Okay? They're the lead underwriter. They grab other broker-dealers to create a syndicate. like they'll grab Goldman and Lehman and JP Morgan and UBS and all these other firms to create a network or a syndicate for them to sell the issue to the public, whether it's bonds or stock or anything. So the syndicate, the due diligence meeting is done right before the effective date to make sure all the I's are dotted and the T's are crossed and everything's copacetic. And then once, remember something, no money, no orders, no advertising. During this 20 days, no money, no orders, no advertising. No new research. However, you are allowed to do a thing called the tombstone. Let's see if we can do this right. Tombstone offer. Of course, it goes to that. It helps to see things sometimes. So if you can see the screen, oh, it's all funny. Where is it? I have to go back to this. It's never as big as it. Okay. So can you? I don't know if you all can see this right here.
Yes.
Yeah. Okay. This is literally what it is. It's just a list of what they're doing, how much money they're trying to raise, that, and then like usually it'll have stuff like who's issuing it and stuff like that. I mean, that's really all it is. Here's one from Chrysler. See if it works. Yeah, of course the internet's slow in a second. But that's literally what it looks like. So the whole thing is it's literally just listing what we're issuing, how many shares, but it usually doesn't have a price or anything like that. That's a tombstone. That's how we can sort of advertise. As long as they follow certain rules, which you don't have to worry about, they don't have to file it as advertising, and they're allowed to do it during the 20-day cooling off period. Once it's effective, then we allocate the shares to the various places. Okay. To whoever bought it, they do indications of interest. We say, oh, you wanted 1,000 shares. Well, we can only give you 700, and that's what it was. So when Reddit went public last spring, because I run a little Reddit subreddit thing, I'm a moderator, they gave me an opportunity to get shares during their IPO. And I was so happy because understand, none of you can buy in an IPO right now. None of you can buy in an IPO because you work for a broker-dealer. That was me since 1989. I shut down my broker-dealer in 22, the end of 22, because I wanted to focus more on the tutoring, and that's what I'm doing. I was finally able to buy in an IPO, because remember, this could be a test. All of you who work for a broker-dealer are considered restricted people, and you cannot buy in a common stock IPO. Bonds, preferreds, additional offerings, totally cool, but a common stock IPO is a no-go. Now, I was happy I put in for 1,000 shares. I didn't have the money, but I knew I wouldn't get it all. And they came back and said, no, we can only give you 500 shares. So I bought 500 shares, okay? That's literally, I bought 500 shares and got a piece of it. And when it went up, I sold it. But the point was I got shares. I went through the whole process. Here's a preliminary prospectus. They sent it to me. I said, oh, I want to buy 1,000 shares. That's my indication of interest. And then after it's effective, they said, listen, it's going to be $34 a share. You can get 500 shares. I said, fine. That's allocating the shares to me. And they go, okay, well, Ken said 1,000. You only wanted 500. That means there's somebody else can get 500 shares that we can send it out to. And that's what they did. Now, once we send the IPO out, we're done. We're going to go to the Act of 34 in a second. But that's it. It's out there. We allocated the shares. The Act of 33 ends right there. Now, jumping around, what if I don't want to go through that whole process? What if I don't want to sit there and just raise money, and it's going to be expensive? I don't want to raise billions of dollars. I'm looking for a smaller amount. So they have other types of offerings. These are what they call exemptions. Okay. So the first one. The first one is if it's small, Reg A plus. Tier 1 is up to 20 million. Tier 2 is up to 75 million. They're not going to go crazy in the test. Anyone can buy it. Anyone can buy on this. Even you guys, because it's not an IPO. Except for non-accredited have some limits. And I'll get into accredited. So non-accredited investors have some limits on how much they can buy, but they can all buy it. This is smaller. It's not, you're not really registering with the SEC. You're it's kind of a loophole around the system. Then we have a Reg D. This is a private placement. We're just selling to rich people. And what does rich people mean? Accredited. Now, as a sidebar, let's jump over here for a second and go, what's an accredited investor? So I always remember 1, 2, 3, accredited. That means if your net worth, liquid net worth, means no house or car, is $1 million, you are accredited. Or if you're single and make 200 grand a year, you're accredited. Or the third one is if you're married and you make 300 grand a year, you're accredited. So I always joke around and go, okay, 1 million net worth, 200 single, 300 miserable. I mean married, just so you remember it. So 300 is if you're a couple, 200 single, and 1 million net worth. Now, you can be any one of these. You don't have to be all three of them because you can't be single and married. But there it is. Or if you have the Series 7 or Series 65. 7 or 65. Either one of those are accredited. So if you're going the SIE, then 6 route, and then you get the 63 and 65, once you get the 65 and it's actively held, you are then accredited a person, and you can buy on private placement. Woo-woo. Okay, so now, there are 3 types. 504, and remember, just learn the basics. Don't go too deep on this. 504 up to 10 million. Anyone can buy, accredited or not. 506B is unlimited amount of money. So up to 35 non-accredited. I could spell that out. Accredited. And then unlimited accredited. And then the last one, if you can see it, is 506C. Same thing, unlimited amount of money, but only accredited. No unaccredited. So 504 up to 10 million, 506B, unlimited, but you unlimited money, 35 non-accredited, not one more, and then as many accredited. 506C is only allowed to do accredited. You cannot have any unaccredited investors. So far, did I lose anyone yet?
What was the 3 for accredited? 1, 2, 3?
Okay, 1 million net worth.
Yeah.
200 salary, single, or 300 salary, married.
300.
Or as a couple. And it should be like, it's not a one-off thing. It's like you're consistently making that kind of money. The vendors will trick you and say, a couple makes 350 grand a year, but he just or she just retired, so then they wouldn't be accredited because they're not expected to keep. When you retire, you're not expected to make as much as you were. Although the goal is to have enough residual income that it doesn't matter. Okay. Those are 2 of the exceptions so far. Are we okay? Can I erase this or no?
I have a question.
Get it.
I don't remember running into 504 and 506B. What is that?
So they're just parts of Reg D.
Oh, okay.
So Reg D is a private placement. Under Reg D, it's either 504, 506B, and C. Here's the thing. May not see it. You might. I don't want to. There are certain things that are easy that I would rather say, and if you don't get it, you're happy. But if you do, you're even happier because I brought it up. Okay. So they're just different types of Reg D, how you set them up. Okay, moving on. Another exemption is a Rule 147. That's all one state only. That's why it's exempt from federal law, because it's one state only. Okay. You all live in Texas, right? You all understand the whole thing of states' rights. So the whole point is if we do this in one state, it's exempt from SEC regulations other than fraud, but pretty much everything's in one state. And then what I remember this is that a long time ago, Ben and Jerry's did this in Vermont when they raised money. And how many flavors does Ben and Jerry's have? 147. Making it up. It works. So they have 147 flavors. That means Rule 147 is one state only. Now, the last one is a Reg S. That just means it's sold out of the country. That's it. Reg S is out of the country. Okay. Those are exceptions to the Act of 33. So if you don't want to go through the Act of 33 and spend all that money, you can do one of these things. Reg A if you're under 75 million. Reg D if you just want to sell to private investors. Rule 147, which is one state only. And then Reg S, which is out of the country. Now, anyone who took it, I have a question for you. Anyone who took it, did you guys see anything to do with Rule 144? Did any of you see questions on 144? Yes? Okay. So I'm going to talk about both of them now, because there's two of them. Like in my mind, it should be on there, but you never know. So here's the deal. If there's two types of Reg D. 144. We have control people or affiliates. Those are like the people who I call them the pods, PODS. PODS. Partners, officers, directors, and big ass shareholders. That's 10% or more. Pods, the pods. Partners, officers, directors, and big ass shareholders. They all have to follow these rules. So they have to follow, they have no holding period. Remember, no holding period unless it's restricted. And they just have to follow these rules. One, or the 144 rules. They can sell the greater of 1% of outstanding. 1% or the 4 weeks average trading volume, whichever is greater. And they can do that 4 times a year, which is really every 90 days. That's for control people. That's like Elon Musk, Richard Branson, Bill Gates, anyone who's an owner, even public companies, publicly traded companies, they do this. The reason they do this is so that if you're one of these people, you might have access to some inside information or feelings or nuances. They don't want you dumping all your shares in 1 week before it crashes. So they limit how much it can sell. So in reality, if you're a 10% owner, it should take you 3 years to sell all your shares. So if you're dumping it because of an emergency, you're going to get stuck with the rest of it. Now, that's for control people. The other one is for restricted shares, which is really just Reg D. Shares, which is Reg D. Now, that means the only rule here is that if to hold it, when you buy shares of a Reg D, you're accredited. You have to hold it for 6 months, fully paid. After, you can sell what you want. If you want, okay? That's the difference. So 144 for control people, no holding period, but you have to follow these rules. If you buy restricted shares and you want to resell them, you have to hold them for 6 months. However, if you are a control person who buys restricted shares, you have to wait this 6 months and then follow these rules. Again, control people, no holding period, follow the rules, restricted, holding period, but no volume restrictions. But if you're a control person who owns a restricted share, you have to follow this and then sell it this way when you can. Now, on the restricted shares, there's one exception to this called 144A. There's always an exception, 144A. That means you're selling. Does anyone know who you can sell to under 144A? A QIB. That's a qualified institutional buyer. That means you're managing 100 million or more. Okay. Now, one more thing I'm going to add into this whole Act of 33 before I leave and head into the next year of Act of 34. Is everyone okay with this? Can I move on? Anyone need me to wait a second? Okay. Let me know when I can move on.
I think we're good.
Okay, good. Okay. Now, you know that when you buy shares of an offering, you must get a prospectus. Okay. You're going to get a prospectus, which is just the disclosure doc. Now, the deal is with the prospectus, you must get it by completion of the trade, which is pretty much settlement. You'll see over the time that I can't type. Okay, settlement date. Now, the question is, for how many days after the effective date are you subject to this rule? If it's an over-the-counter, which means non-exchange listed IPO, you have to get it for 90 days. That means for the next 90 days, you have to get a prospectus by the completion of the trade. If it's an over-the-counter follow-on, which is like, remember, so when I issue shares once, that's an IPO. I can do it again and again and again. I can keep raising money, so that's a follow-on. That's very biblical, 40 days. If it's exchange listed, exchange IPO, that's only going to be 25 days. And if there's an exchange follow-on, it's 0 days. Because the whole point is always think of it, the less risky something is, the less we have to send the disclosures. So if it's over-the-counter IPO, that's the first time not listed, super risky. If they're going to issue more shares, well, it's been out for a little bit, so it's a little less risky, so less days. Anything on an exchange, we can't actually say it's less risky, but literally, if it's on an exchange, every broker-dealer has a research report. They're all doing some sort of research on it, stuff like that. That's only 25 days. And if it's an exchange follow-on, it's already trading. Everyone knows about it, so we don't have to do a prospectus at all. We good with this?
Yes.
Good. Okay, here we go. Now, the Act of 34. This is all about this is a second act, so it's a secondary market. So let's be clear on this. 1933, primary market. That's like if you see the word underwriter, prospectus, syndicate, new issue, IPO, all these words. These are all money raised. That's all has to do with the 33. 34 is the second act, so it's a secondary. So I have a whole acronym, but we're going to talk about this first. So in the secondary market, there are 4 markets. There's the first market, which is not the primary, it's the first market. That's exchanges. Second market is over-the-counter. They call it unlisted. So let's put up here next to the exchanges. You can put the word listed. Listed on an exchange. Over-the-counter means, well, exchange listed means it's trading on an exchange, and when you trade, you're actually doing it on the exchange where it's electronically transferred, and there's a lot of rules to it. Over the counter, it's literally one broker-dealer buying from another. Over the counter means over my desk, okay? So over my desk, I'm trading it between two, like JP Morgan buys from New York Life or New York Life buys from Mass Mutual. They're buying directly from each other, not through an exchange. So that's over the counter. That's called. And there are stocks that can, if you're trading here, and if that's where you're listed, you can't trade here because you're too small. But if you're trading here, you can trade over the counter, but it's called the third market. That's OTC trading of listed securities. This is how it works. I see IBM trading on the New York Stock Exchange, and I see it's offered at $30. So I could buy it at $30. I go, oh, wait a second. I see that Goldman Sachs is offering it on their own at $29.99. That's better than $30. So instead of me going to the stock exchange and buying it at $30, I'm going to go directly to Goldman Sachs and call them up and say, hey, I want to buy your stock. They sell it to me at $29.99, and we're off to the races. So that's what it is. The third market is allowing for more liquidity because it's letting you can make offers on your own on the third market and not have to go through the exchange. Fourth market. That's for institutions. And you see dark pool, ECNs. They're really just electronic platforms to trade from. Now, understand something. The way the rules go is that if you want to trade on the first or second market, or even raise money, if you want to do any of these things, you have to be a FINRA member, which New York Life is. So broker-dealers have to be FINRA members because they have to be to trade. The fourth market allows non-FINRA members to trade. So it allows institutions to trade with each other through this electronic platform. Now, the secret is that it's really run by broker-dealers and the exchanges, but it's not really on the exchange or through the broker-dealer. So it allows institutions like hedge funds, banks, money managers, they're all non-broker dealers. So the only way they can trade is either through a broker-dealer or on the fourth market. Is that okay so far? Okay. Now, Act of 34. Now let's go through the acronym. MISSPERMS. MISSPERMS. So this is an acronym that I use to remind myself what the Act of 34 covers. Number one, margin. What's margin? Well, margin is using leverage to buy securities. So normally you'd have to buy, if you want to buy stock, you have to pay 100% of the value, blah, blah, blah. However, margin allows you to only put down 50%. Like any of you that own a house, unless you're super rich, you didn't pay cash for the house. You put down money and then borrow the rest. It may be cash now, but it probably wasn't when you bought it. So it's like the same thing. You're leveraging your money, except for margin under Regulation T requires 50%. So it used to be you only had to put down 10%, which caused a couple of problems. Now you have to put down 50%. And that's why the problems was why the Act of 34 came in and addressed it and said, okay, anything to do with margin is going to be covered by Regulation T and is covered by the Federal Reserve Board. Those are the ones who write the rules. That's margin. What you have to warn people about margin. Hold on, I die. The thing about margin is, since you have to put down 50%, you have to warn the customer that since you're borrowing money, they're increasing their risk. They're increasing their risk. They're increasing the risk and the reward. So the reward will go up, but so will the risk. And they have a thing called minimum maintenance. So if you buy stock and it goes up, that's great. But if it goes down, remember, so if you buy 10,000 in stock, you're going to deposit 55,000. That means your debit is going to be $5,000 also. That means you borrow that. So this deposit that you put down, I'm going to change it to equity. That's what it really is. And in this case, your equity is 50%, you're good. Even if it goes below 50%, you're good. But it cannot go below, on the long margin, cannot go below 25%. On the short side, and we'll get to short selling in a bit today, hopefully today, short selling can't be lower than 30%. So your equity can't fall below those numbers, or you get a maintenance call. Okay, that's margin. Again, margin is regulated by the Federal Reserve. Remember that. Margin is regulated by the Federal Reserve. Insiders. It defined who insiders were. So we have people who are like partners, officers, directors, stuff like that. And anyone who has possession of material non-public information. Now, the thing is, having the information isn't the crime. Acting on it, trading on it is. I mean, that's what Martha Stewart did. So her friend told her, hey, the stock's going to be really bad in the next couple of days. So she sold her position, saved herself $600,000, and then she went to jail. Now, I think it's funny. After jail, I wish I was in her issues. She had house arrest, and she had to wear an ankle bracelet. Her house is so big, she couldn't go to, parts of her house she couldn't reach because the bracelet wouldn't, the recording stuff wouldn't reach that far. That's a nice problem to have. Okay, now, so again, insiders are people who have information or are considered affiliates. It's not a violation unless you trade on that information. Now, if you do become in possession of inside information, does anyone know what you're supposed to do?
Keep it to yourself.
That's one thing you can do. But what if you're a rep, what should you do? Who do you tell? Okay, I'm going to do this. Let's have some fun. I'm going to bring up a question. See how we do.
Yeah.
We're all going to guess, and I'll show you how a question would look on the exam. How they ask it. Once I get it up. Here we go. Here we go. This is what I wanted. This is how a question could look. Number 14. Everyone take a second to reel it in.
Officer compliance.
Okay. Yes. The other thing you tell the officer in the compliance department or your supervisor. These three things, you go to jail. These three things are violations, and if you do this and they trade, you are going to be walking around in the silver handcuffs. Okay. If they can prove it, that's one thing, but I'm just saying now. Okay. That's inside information, insiders. Now, the second S is the SEC. They created the SEC. Now, remember, before, the Act of 33 said you have to file the registration statement with the SEC, which is an entity wasn't created until a year later. Classic federal government. Okay, so now this one S is for short sell. They had rules on short selling. So prior to 34, there were no rules on it. You could just short nilly-willy. Now, understand what shorting is. Shorting is, let's say, IBM is trading at, I don't know, $50. And Daniel goes, I don't think this stock is going to do well. I think it's going to go down. So what he will do, say I own, say Ken owns 1,000 shares. Say I own 1,000 shares. I'm a big shot, okay? I own 1,000 shares of IBM. It's trading at 50. That's awesome. Dan goes, hey, Ken, can I borrow your shares? And I go, sure. Now, it's not this casual. It's through the broker-dealer. But so what's going to happen is Dan is going to borrow the shares from me. And then where are they trading at $50? He will then sell 1,000 at 50. So 1,100. So he is now going to have 50 grand in his account from selling the shares. Now, wait a second. He sold my shares. That's kind of crazy, right? So he borrowed my shares and sold them. In any other industry in the real world, that's a felony, and he's going to jail. But in this one, we all are for it. So he sold 1,000 shares at 50 for 50 grand. Now he's hoping that the stock will drop to like 40. And then when I go, hey, Dan, can I have my shares back? He's going to buy them back for 40 grand for the $40 times 1,000. And he keeps 10 grand because he buys them for 40, gives me my shares back, and then he makes 10 grand. Does anyone not get that? So again, he's borrowing the shares, selling them like they're his own, and then hopefully buying them back at a lower price. Now, I have a question for you. Where's the risk?
Stock goes up.
Right. So instead of going to 40, maybe it goes to 60. And I go, hey, Dan, can I have my stock back? He goes, sure. Oh, my God, it's at 60. So that means he has to go buy it at 60 and spend $60,000 when he only got in 50. So he's going to lose 10 grand there. The question is, how high can stock go? Forever, right? Yeah. So when he shorts those shares, he has unlimited loss potential. So what he could do, and I'm jumping the gun here, what he could do is if he sells a stock at 50, he could also, we don't have to do the math on this, buy a 50 call at 3. Now, what does a call do? The call gives you the right to buy at 50. So technically, no matter how high the stock go up, if he bought a call, he could still, but he'd have to buy 10 of these, but he could buy the stock at $50 no matter how high it goes. That's how you would hedge a short position. If you're short stock, you buy a call to protect. We'll come back to it later. Just throwing it out there since I'm here. Now, the P, proxy rules. This is just getting to vote by mail. That's all it is. Proxy rules are just voting by mail. They used to not allow it. Now they do. Oh, sorry. Before I move on to the short selling, off the short selling. Sorry about this. When you short, you can't just short willy-nilly. You have to get what they call a borrow or a locate. Either you have to borrow the shares or locate them before you execute. That wasn't the case in the 20s and 30s because you could just short them and not worry about what it was. So now they have to get it. You have to get a borrow or a locate before you execute the order. Now, proxy rules are just, again, you can vote for stuff by mail. E, exchanges. The exchanges, prior to this, all the exchanges were like boys' clubs. So it's like 1,300 or 1,366 old men and old rich people. And all they did was trade with each other and beat each other up. But once it started affecting the real world, people started getting upset and they go, okay, we got to make rules. So they made all the broker-dealers and exchanges have to register with the SEC and be under the regulation of the SEC. And if they break rules, the SEC can go after them. Okay. That's the exchange. Next, R, reports. That's like when you issue shares, right? Okay, so if I issue shares, like say I went public, okay, and I went with under the SEC. I registered that way. I would have to do certain financial reports every quarter, every year, every once in a while. So these are reports called. We have a 10Q. You're welcome. 10Q. I think that's a funny joke to me. 10Q is quarterly, then 10K is annual, and then an 8K is special situation. So every quarter we do a 10Q. Every year we do a 10K, and then the 8K is for stuff that pops up in between. But what's interesting is that, yeah, normally an 8K is for like special announcements, but I forgot who won. I was Payless or somebody. They sued the SEC to say we should be allowed to publish it somewhere better than that. So actually, as long as you publish your news or whatever in a publicly available website, it meets the requirements of this. Like any kind of news material stuff that pops out, you do an 8K to announce it, or just announce it in a publicly available website where people can see it and you're good to go. Okay, like Twitter, Instagram, stuff like that. Now, the M, this last one is manipulation. That's regulating all the things like trading pools, where a bunch of people get together to buy and sell the stock to create the illusion of volume. Front running, all these things. Front running, churning manipulation and Trough. But trading pools, wash trades, where say you have an account at JP Morgan and one at Schwab or New York Life, and you sell it back and forth between your own accounts. There's no real change of ownership, but you're making it look like there's a lot of volume. Those are all considered manipulative. Anything to do with changing the price to change it. Now, remember, if you place an order to buy or sell or whatever it is and the price moves, but you still want to really buy it, that's fine. But if you're placing an order to buy or sell to actually move the market, that's the violation. The last S is stabilization. Stabilization, they also call it the syndicate bid. Remember before in the Act of 33, we bring the thing public, then it starts trading on the exchange. Well, during the first, 30 to 40 days, the stock may have some selling pressure on it because it's new. So they're allowed, so the lead underwriter, in this case would be New York Life, is allowed to buy the shares at the IPO price or lower to keep it from dropping, which sounds a lot like manipulation, and it is. It's the only form of manipulation that's allowed. There's a lot of rules on it, but they are allowed to prop the price up. And they can't push it up, but if it's up or down a little bit, they can hold it from going down any further. And the reason they do that is so that it gives a little time for people to read about it, see the news, and then decide to join it. So that's the Act of 34. Any questions? Okay.
No.
Good. Real quick, Act of 39 is not really covered in the books that much, but it is a thing. The Trust Indenture Act. Trust Indenture Act of 1939 covers corporate bonds. Or you might see the word non-exempt, corporate bonds. Corporate / bonds. So they made sure that prior to this, again, there's no rules. So under the Act of 39, they said all bonds have to be issued inside of a trust, which means the company has to hire a trustee. That's going to be like a bank or something like that. Call it Bank of New York. They used to do most of them. The point is, anything the issuer is going to try to do to get rid of anything or try to pull a fast one, the trustee's job is to make sure that they don't. Or if the issuer goes bankrupt or is about to go bankrupt, the trustee is the one who sues them into bankruptcy court. Okay. Now, what's going to be in the indenture? whether it's secured or not. If it's secured, it's going to be secured by so understand what a bond is. So a bond is debt, and we'll come back to that. But a bond is debt. So basically, it's an issuer borrowing money from investors. And if you guys are going to borrow money from me, or you're going to lend money to me, you want some assurances that's going to be paid back. So in the trust indenture, it's going to have certain things like, is it secured? So a couple of things like a mortgage bond is backed by property. That if the bond fails, they'll sell the property to pay off the mortgage. A equipment bond sounds just like what it is. We have equipment like tractors, trucks, stuff like that. They're going to sell the equipment to pay it off if I default. And then the last one is called collateral. That's just like stocks and bonds for portfolio. So those are three things that would secure a bond. So if it's a secured bond, and it'll be listed in the indenture. If it's a mortgage bond, it's secured by property, equipment, obviously, and collateral bond is followed by stocks and bonds that they own. Okay, not their own, the companies they invest in. The other thing it could be is listed if it's unsecured or not. Does anyone know what another word for unsecured is? Debenture? Okay. So that's unsecured means debenture, which means the only thing protecting it is the full faith. They may call it a full faith and credit. Faith. Okay, that's a good start on that act. We'll come back to it later. I just want to give a little beginning of it. Just write this down. Investment Advisors Act of 40 covers federal covered advisors. Then remember, you work for a broker-dealer. The broker-dealer does trades. You do execute transactions. You can give advice, but you can't charge. However, if you worked for like New York Life Wealth Management or something like that, say that was an investment advisory arm, that's a firm that actually gives advice and charges for the advice. Instead of just getting commissions, anytime they give you advice, they charge you. That's what an investment advisor does. But they're usually pretty good because what they do is they usually take like a percentage of the assets to manage it. So the more they make, the more your business grows, the more they get to walk away. Okay. The other one is the Investment Company Act of 40, which we'll get to. That's all about mutual funds and annuities. Does everyone here have the insurance license?
Yes. Yeah.
Okay, so the annuity stuff shouldn't be all that bad to you. At least the fixed part. The variable shouldn't be as bad either, as long as you understand that it's just the only difference is that it's the only difference is that they one's a security, one's not. Okay. Somebody ask some? Okay. Okay. Now let's jump into the different ways to actually raise money. Not the process, but what we can do. So one of the ways we can do is give up equity. Okay. One of the ways we can do this is we can give up equity. Okay. So equity. Okay. Now, equity is actually ownership of the company. So like if you ever watch Shark Tank and they buy, I love Shark Tank for this stuff. So the person comes in there with a great idea, how to clean dishes or something like that without bending down or something like that. Okay, now, if I want to raise money, but I don't want to owe this, the most conservative way for me as an issuer to raise money is to issue common stock. That's equity. That's ownership. I'm giving up ownership of my company to get some money. So I'm going to give up 10, 15, 20%, maybe 30, maybe 50, who knows, to raise money. So I'm lowering my ownership, but no, as a common stock owner, does anyone know what some of the rights are when you buy common stock?
Vote for the board of directors.
Yes. You can vote for the board of directors. What else can you do? What else can you vote for?
Stock split.
You have stock splits and mergers, right? Well, you can vote for a stock split, but not a stock dividend. You can vote for mergers and takeovers. Now, as far as the voting for board of directors goes, we got to worry about statutory versus cumulative. So, there. Now, let's say, let me give 3. I want 3 board seats. 1, 2. Okay. Let's say you own 100 shares. Now, under statutory, you will get 100 shares to vote for each box. You go, okay, these are my 100 shares. I'm going to put this person in. I like put that in there. Boom. Those are the people I like. I'm going to try to vote them in. That's statutory. You get 1 vote for every share you own. However, if it's cumulative, that means instead of getting 100 votes per seat, you're actually going to get 300 votes to do whatever you want. So you can put like, you can put 200 votes. You can put 200 votes on that person. Let's say 200. And then just, you know what, this person over here, 100. You can make it up. You can mix and match any way you want, as long as it equals the 300, which is, remember, because you're getting 1 vote for every share you own times the number of board seats. Okay. Remember, statutory is you get 1 vote for every share you own. Cumulative, you get 1 vote for every share you own times the board seats. Okay, so you get, if you have 3 board seats and 100 shares, you get 300 votes to do whatever you want with. If you do statutory, same 300 is going to be split up between each board seat. So you can't lump it on. Okay, that's one of the rights. What other rights do we get as an owner of commons? How about the right to freely transfer? Works. The right to freely transfer is like, if you buy shares at 10 in the morning, you can sell them 2 minutes later. You can sell them an hour later. Like if you were to invest in my company, it would take you weeks and lawyers. And then when you find out I'm a fraud, you're going to sell it, weeks and lawyers, you're getting out. So the whole point is that if you're buying in regular companies, it's not freely transferable. It's not easy to do. But if you buy shares of a company on an exchange or even maybe over the counter, you have much better. You have you can get in and out very quickly. That's important. The right to freely transfer. You have the right to inspect the books and records, which isn't nearly as important. You have the right to receive a dividend. What are the ways I can get a dividend? One is cash. I get cash dividends, which is great. I can get stock dividends, which is good. I can get stock of another company. I can get product. Like if Gillette comes out and they go, oh, we're going to do a new razor, boom, they put it out. They give it to everyone, shareholders. They don't normally do that, but they can. So if I get a dividend, we used to use an acronym called DERP to keep it in mind, but it's not quite the same. So it's DERP. So company decides, oh, we're going to declare dividends. We're going to say, this is August 23rd. We're going to declare a 50-cent dividend to anyone who's an owner of record on 9/2. Okay, so that means if you're an owner of record by September 2nd, you get the dividend. So let me make it 3rd because I don't want to run into Labor Day. Okay. Now, and then payable date could be like whenever, nobody cares. That could be like 9/26. Now let me explain how this works. So if everyone's going, wait, I know this already, this is cake, tell me, I'll move on. So now, Monday, Tuesday, Wednesday. So we said the record date is 9/3. So we're going to say that's Thursday, 9/3. We're going to say 9/3. That's Thursday. That means you have to be an owner of record by Thursday. Okay. Now that means, let's talk about it. So regular way settlement is T+1, right? So we buy stock on Monday, it settles on Tuesday. Boom, we buy stock on Tuesday, we settle on Wednesday, we're good. Now that means we get, as long as we settle by Thursday or before, we're good. Now it used to be if you bought it on Wednesday, it would settle on Friday, which means you're too late. They changed it now. So if you buy it on Wednesday, you settle on Thursday, so you get the dividend. If you buy it on Thursday, you settle on Friday, you don't get the dividend. What happens since, so remember, the X day and the record date are now the same. Because if you buy the shares on Thursday, you settle a day late and $1 short, you don't get anything. Now, what happens to the stock price on the X day? Does anyone know what happened to the stock price on the X day? They dropped the price. So since if you buy it before September 3rd, you're getting a dividend. So the price is built in with a dividend. Okay. Once they pay the dividend, or once you hit X date, the stock is no longer trading with that dividend. So they drop the price. Anybody have a problem with this? I'm putting you all to sleep. Okay. Now. Okay. So that's the one you answer. The one I'm putting you to sleep, you do answer. I got it. Okay, so it works for me. Okay, so now, let's talk about a stock dividend. Let's say you own 100 shares at 50. We're going to do a stock dividend and a stock split. So we have a 3-for-1 split, 5-for-4 split, and a 10% stock dividend. Okay. Does everyone have paper? I want you all to work on this. I want you to give these the 3 scenarios. I want to do it with the 3-for-1 split, 5-for-4, and a 10% stock dividend based on 100 shares at 50. I want everyone to work on it. I'm going to give a drink of water while you do it. I want to see, and then we're going to go over it, and you guys got to tell me how many. No, how to do it. By the way, super easy.
Let us struggle and then teach us the easy.
Can you see it?
Yeah.
Yes.
Okay. So the 3 different scenarios. No talking. Okay. Do we want more time or no?
Please. I'm not here.
The way I do it is super easy. Okay. Here we go. This is what I do. So we know that 3-for-1 split is forward. That means we're getting 3 shares for every one we own. So we're going to do 3 divided. So I do this. I do the first number divided by the second. 3 divided by 1. That gives me a grand total of 3. So then all I do 3 times 100. That gives me 300. And then I do 50 divided by 3. It gives me 1667. That's it. That's 1. Now, does anyone not get what I did there?
What?
So I'll do it again. I do the first number divided by the second, 3 divided by 1, that gives me a multiplier of 3. And remember, multiply the shares, divide the price. Multiply the shares, divide the price. Little things. So now, I'm going to multiply the shares. 3 times 100 gives me 300 shares. And then I do 50 divided by 3 gives me 1667. So this is my new position. I had 150. Now I have 300 at 1667. And I'm assuming that's the price. 50 divided by 3. I think it is. Now, let me go to the next one. 5 divided by 4 divided by 4 equals 1.25. We all agree with that? So I'm going to do 100 times 1.25. That gives me 125. Then we do 50 divided by 1.25. That should be, I should do the calculator, but I think it's 40. I can't do math. I'm an ADD kicks in all the time. 50 divided by 1.25 is 40. Boom. That's right. So now after the fact, we have 125 shares at 40. Literally no change in value. The numbers change, but the value doesn't change. Doesn't matter at all. Okay. Next, 10% stock dividend. All I do, I take the 10 and I put a 1 and a decimal in front of it. So 1.1. If this is a 25% stock dividend, 1.25. 15, 1.15. 5, 1.05. 30, 1.3. I always put 1 and then decimal in front of it. And that's my multiplier. 1 times 1.1 is 110. Then I do 50 divided by 1.1, and that should be 45. And if you look, if you multiply 100 times 50, you get 5 grand. 300 times this is pretty much 5 grand. This times this, 5 grand. This time this. Has anyone not get what I did here?
If you're gonna go from here and 10% side.
Can you do that?
You want me to do the 10% one again?
Yes, but it's like
Everyone always has a problem with that because what happens is it just looks different. Let's do a different one. Let's do a 15% stock dividend. So what am I? Does anyone know what I'm doing here?
yes.
I do that. Does that make sense?
Yes.
Then I just do the same thing. Right? And then I do 50 divided by 1. 50 divided by 5 is 43.47. Do we all get that? I want you guys to do one on your own here. 20% stock. Everyone do this. I'll give you a minute. 20% stock. Okay. Let's do it. We're going to do 1.2. So you have 120 shares. And what's my market price?
41.67.
There you go. Did anyone not get that?
55.
So always remember, whatever the number you're doing, you're multiplying the shares and then dividing the price by that same number. Okay.
I feel like I'm missing this.
Hold on. It's hard to hear you. Say it again.
I feel like I'm missing a step. We're missing a step on the process.
You're missing the first step.
Yeah. Can you go back to that?
Yeah. Okay. So whoever said that, I want you, you're going to do it with me. Okay. Say I have 200 shares at 50. Okay. And I have a 25% stock dividend. What do I do? Is this the part you're getting messed up on?
At 1.25?
That's all you're doing. Yes. It's not even, sometimes it's just so easy you miss it. Okay. What do you do with the 1.25 now?
Times 200. You multiply it by 200.
And then what do you do over here?
You divide
By
it.
55. 1.2.
Yep. So this would be what, 250? And then what's my stock price?
40.
40.
Yep.
So 250 shares.
Now, what's going to be good for you, okay, is sometimes, most of the time, they'll give you 4 choices and only one of them where there's more shares worth less. A lot of times there's going to be more shares, more price, out. More shares, same price. No. If it's a forward split, it has to be more shares and the price is low. You still not getting it or no?
I think we don't understand why you're putting a 1.
Who cares? It's because it's 100. It's making it 100%.
Nice to meet teachers. I didn't know why.
No, seriously, it doesn't really matter. But the reason I do that, see, sometimes when you're doing tricks, don't worry about the why. It's like magic. Okay, so understand what I'm doing is I'm making it 125%. So I'm taking the 1 puts the original price in. So if you just did Here's why. If you did it the other way around, and this is why there's a problem. The other. If I could do this, I could say, okay, what's 25% of 200?
That's what I do.
25%.
So I could do 25% times 200. That means it's 50. So now I have 250, right? Right. So then I have 250. And then the problem is, it's not the problem is you're trying to find out what 50 is 125% of. You can't just take 25% of 50 and subtract it. It doesn't work. It's not the same number.
I got it.
So what you could do, if you don't like this way, you could do this. What's 200 times 50? Would that be 10? That should be 10 grand, right? If you do the 10 grand divided by that new amount, you get the same number.
Got it. I like that way.
Okay. Some people resonate with that better. It's all good.
Makes sense. Thank you.
No worries. Okay. That's okay. No, we're not done. But okay. So that's the beginning. You will definitely get 4 or 5 questions on that. 100%. Don't give them up. They're too easy. Those are like, if I find it you got them wrong, I'll have the proctor smack you in the back of the head. Okay. So now, although I don't think they would down there. Everyone carries. Nobody's going to hit anyone down there. Okay. So now we have that. So let's talk about it. We have the right to vote. We have the right to freely transfer. We have the right to receive a dividend, whether stock or cash. We have the right to inspect the books and records. And we have what they call a preemptive right. Now, a preemptive right is that if you own shares, so if you altogether own 10% of my company, and then I decided to issue another 50%, wouldn't that dilute your ownership? I think that would dilute your ownership a little bit. So what I'm going to do is I'm going to give you the ability to increase your ownership or to maintain your ownership. So you will not have to do the math on this. You just have to understand the concept. If I have 1 million shares and you guys own 100,000 shares, you guys are 10% owners. If I happen to issue an additional 500,000 shares and you don't get any more shares, you're like now a 7.5%, I think 7.5%. You're a smaller ownership. So I'm going to give you the ability to buy more shares enough to keep your percentage ownership. So I'm going to send you what they call a preemptive right. It's called a rights offering or preemptive right. Again, don't worry about the math, just worry about the concept. It's basically saying, I'm giving you, the shareholder, the ability to buy shares from me directly before I go to the public. And usually it would always be at a discount. So you get to buy shares at below where I'm going to sell it to the public because you're buying it directly from me. But I'm going to give you enough so that you maintain, you're not increased, but maintain. So I'm going to give you enough rights to buy another 50,000 shares. Again, don't worry about the math yet at all. Now you're going to get, this is what you do have to know. You're going to get 1 right for every share. 1 right for every share you own. So if you have 100,000 shares, you're going to get 100,000 rights. But that doesn't mean you can buy 100,000 shares because that would give you a higher percentage. Again, you don't have to do this, but I would say in the prospectus when I send it, you will have to end in 2 rights to get a new share. So if you have 100,000 rights and you hand them in and you have to get 2 for 1 share, you're going to get another 50,000 shares. So after it's all said and done, if you do happen to exercise these, you're now going to have 150,000 shares, which keeps you at 10%. Now, if you get the right, do you have to use it? Nah. There's a bunch of things you can do. Once you get a preemptive right, you can do certain things and you can't do certain First of all, you get a right. You can sell it. It's in the market. Go, screw it. I'm just going to sell it. I don't want to buy any more shares. You can sell it for whatever the value is. You won't have to figure that out. You can exercise it, which means use it and buy more shares. You can give it as a gift. Sure, that's fine. You can give it to your little nephew and say, hey, here's a gift, but it's going to go, you better use it quick because it expires in 3 weeks. Or you can just let it expire. Now, that's moronic, but as long as it's only your account and not a custodial account, you can do that. You're allowed to be a moron on your own. Okay, so a right gives the owner, existing shareholders, the ability to maintain your ownership if the company issues more shares. You can, again, you can give it as a gift to someone, you can sell it, you can trade it, you can let it expire. You just cannot give it back to the company. Okay. Now, why do people buy common stock? Does anyone know why people buy common stock?
There's common stock.
Yeah, that's,
Ownership.
yeah, so, okay, that's fine, I do, but I mean, if you own shares of Ford, are you happy that, oh, I'm an owner of Ford, or do you want more out of it?
Liquidity.
Do you want appreciation? You want it to go up, right? It's some of it's sounding bubbly, so I'm assuming you're saying that. I'm going to assume you're all saying smart things. So its stock is going up. That's appreciation, that's growth. You absolutely want that. That's the number one reason. The second reason is income. Maybe you get dividends, maybe you don't. Remember, the board of directors declares the dividends. There's no guarantee. And then the last reason nobody ever thinks of is what other than like last month, what's been kind of crazy the last 3 years?
Inflation.
Yup. So common stock is the best inflation fighting tool there is. Now, if it's crazy inflation, no, but regular inflation, common stock beats every time. So common stock is much better, is the best inflation fighting tool there is. Okay. Now, let's go over this. So we got that down. So now the next one is, what if I want more consistent? Oh, sorry, I'm going to jump around. If I buy all my stuff in the US, I'm somewhat diversified, but I'm not completely diversified. Is there anything I can do to buy shares to truly diversify my common stock portfolio?
Yes.
What?
Yes.
ADRs?
Yes.
Good.
So, sure.
So we buy ADRs.
Yes.
Okay. So it's hard to hear, so I'm just going to assume again. So an ADR is like when you buy shares of a foreign company, okay? The ADRs are when you buy shares of a foreign company. So the way it goes is you're not buying them directly though, because you can open an account, you go to London, you open up a broker's account with like deeds and whatever, and then you can buy shares, okay? But that's a pain in the butt. So what I'm going to do is instead of that, I'm going to let Bank of America go buy a bunch of shares of British Petroleum, package it up, and then sell the package in the US. So an ADR is like a US bank goes, the foreign branch of a US bank, they buy shares of a company in a foreign country, then they package it up and then sell the package in the US. So this bottle of water is like an ADR. Now, it goes up and down based on what the stock does in Europe. It doesn't have to be Europe. It could be Asia, whatever it is. Like the first one I'd ever heard of was Telmex, Telephone de Mexico. I was like, okay, it works. Okay, so basically, instead of me actually buying shares, going to Mexico, opening an account, I bought an ADR of Telephone de Mexico. If you want to buy Nestle shares, that's an ADR. If you want to buy British Petroleum, it's an ADR. Cadbury, ADR. All these foreign companies, Sony, ADR. All these companies are actually foreign companies, but we created this American security that holds them. Okay, it's like a little mutual fund that owns ADRs. We don't trade it, but it is what it is. Okay. Okay, now, are we okay with this so far? Nothing crazy?
Yes.
Here's the thing. When you buy this, you have business risk, just like any stock, which we didn't talk about. You have business risk, which is non-systematic, and then you have market risk, which is systematic, and you cannot diversify the right. But we're going to add in here, we're going to add to this, is that this also has political risk and currency risk. It's always remember one thing. If they ask a question about a foreign security, currency risk is always an answer. Political risk is probably an answer. So if you have a choice of political or currency and they go, which one is for foreign securities? It's currency every time. Yes, it's both, but every time it's currency, just most of the time it's political. Okay, you can trade an ADR just like a stock, buy it on margin, sell it short, buy options on it, whatever. You can treat it just like the stock, except for it's a foreign security. The only issue with this is that any dividends that it pays out might be taxed by the foreign country, so you may get less because they're withholding some of your taxes, that you. Kind of like when you get a paycheck or something, you don't get the whole thing. They take the taxes out at a time, and you're like, what the hell happened? That's what's going on. Okay. That's an ADR. Now, back to this. What if I want a more consistent dividend? I would buy a preferred stock. Preferred stock has a fixed dividend, okay? Preferred stock has a fixed dividend, which means you issue it at par, which is $100, and you buy. I'm going to buy a 4% preferred. That means I'm getting paid $4 a year. Buy a 5% preferred. I'm getting $5 a year. But they pay quarterly. So if you buy a 4% preferred, you're getting $1 every quarter. If I buy a preferred, I'm going to get whatever it is every quarter. It's a quarterly dividend. I am buying it for income. I am literally buying fixed income. Preferred is a fixed income. Okay. Now, if I buy this, let's go through it, just so we can have one in front of us. Let's say we buy an IBM 4% preferred. Since it's 4% of par, par is 100, it's paying $4 a year, which is $1 every quarter. Is it guaranteed? Nope, because it's a dividend. It's still up to the board of directors. But in reality, we don't really, preferreds will most likely pay, because if they don't, then why the heck would you buy them? So if they ever didn't pay, then people would stop buying their preferreds. They still get paid after debt and before common, but they usually will pay them. Now, there's different types. If I miss a quarter, I miss a year as a regular dividend, I don't owe you anything. You can't. It's not like a bond where we have strict rules on, like, you have to pay because there's a contract. This is literally saying, hey, I'm supposed to pay you, but if I don't, and I'm sorry. So preferreds do not actually owe you the money because it's not debt. So there's no default risk, okay? There's no default risk on preferreds. Now, there's business risk that they won't pay it, but they don't have default risk. But again, if I miss a payment, there's not much you can do, and I'm screwed. So they made a dividend, they made a preferred called cumulative. Cumulative preferred means you have to make up all the old dividends before you can pay common. Now, remember, when they say order of liquidation, okay, when they're talking, you've seen that. Order of liquidation also has to do with where the money goes. So any kind of profits that the company makes, it pays the secured bonders first, then the unsecured, then subordinated debentures, then preferred, then common. So if they don't have enough money, they're not going to pay the dividend. They'll try. I mean, they should, but they'll try. So if cumulative, that means they have to make up all the old dividends. They might even use the word arrears for these. Arrears just means back pay. So cumulative means that even if they miss dividends for the last 10 years, they have to make up the last 10 years worth of dividends before they can pay the common. That's one time. These are just, and by the way, anytime I add a feature, like make it cumulative or anything, that's good. So this is a regular straight preferred. No bells and whistles. So now we added this. That makes it safer, so the coupon's going to be lower. Now we do participating. Participating means that if we have a good quarter, then we will bump the dividend up. So it's a regular dividend. It pays, we'll say participating 4%. But if the company has a good quarter or good revenue or good P&L, then they will bump it up a little bit. Because think about it, regular preferred, if we getting paid $4 a year, if IBM cures cancer, makes a computer that can be implanted in your head, and they have all this money in revenue, you're still only getting $4. So the participating goes, okay, well, we're going to adjust for that. If IBM has an incredible year, we're going to bump your dividend up to like 6%, but only for that year. It's not permanent. It's only as long as the conditions stay. So it participates on the way up. It doesn't do it on the way down. Okay. Now, no, okay. But here's the thing. So if you have a 4% preferred and you make it participating or cumulative or even non-callable, which we'll talk about, then the coupon's going to be lower than the standard because there's less risk. Now, before I move on to convertible, callable means that the company can call the preferred back. They just go, look, interest rates are dropping. I'd rather pay 2% than this lousy 4%. They're going to call the preferred back, and you can't say no. That means we're issuing a bond that at any point it can convert it into common stock. That's all it is. Now, the good thing about this is that if you buy this, since this turns into common, or at least it's a common, it's going to move with the common. If the common goes up, the convertible goes up. Common goes down, the convertible goes down. Okay, because it turns into it, so it's going to move with it. So convertibles are the most volatile of all the bonds because they're converted into stock, so they're treated like equity. Okay. Now, here's what's going to happen. They may ask you what the ratio is, meaning how many shares you get if you convert. And I normally don't do this, but I had 3 people say they saw very, very basic questions on convertibles. So the 3% convertible converts to 25, which means for every bond you convert, you're going to get 100 divided by 25, you're going to get 4. You're going to get 4 shares. If this was a bond, it'd be 40 shares because it's 100 versus 1,000. So that's good. Now, let's say IBM is trading. So now remember something. We're getting 4 shares of common, and it's worth $27. So if we get 4 shares of common and each share is worth 27, what do you think what they call the parity is, where things are equal? Well, yes, we're going to do 4 times 27. 108. So that would be the parity price. So if we were to convert the shares, of the convertible, we would get 4 shares of common, which is worth 27 each, which is worth $108. Now, let's say they call the bonds. Let's say the bond was trading at 103. Okay, stocks trading at premium. We're good with that. It's good. However, you're going to convert it into 4 shares of common. That's going to turn into 108. Now you're going to decide, do I want to sell the bond at 103 or convert and get 108? Which do you think is the better choice?
No, I think.
Yeah, of course. You can get more shares. So I'm going to go through this one more time to make sure we got it. But literally, that's all we're doing. I don't even think you'll get this far. They probably just want you to figure that out or this. So again, I have an IBM 3% convertible. It converts at 25. That means if I were to convert it at a par, it would be worth $25 a share. But since I give you the convertible price, I'm going to do 100 because it's preferred divided by 25. That gives me 4 shares. That means if I convert, I'm going to get 4 shares of common. That 4 shares of common is worth 108 to me right now. You know, 1 or 2, maybe I think it's high. I won't do anything. But pretty much, if it goes here and then the bond is trading at 103, people are going to want to convert and sell it at 108 versus selling it. Does anyone have questions on that?
No.
Yes.
Okay, go ahead.
What, how would the question appear on the SIE? Because that was just totally confusing.
Right now, what I just did or the question?
Well, what would a question look like on SIE?
Oh, yeah, sure. Let me find one. Hold on. Is it this one? I'm going to show you one that's harder than the SIE, okay? Oh, actually, no. I got it. I know. Never mind. I'm an idiot.
Sorry, I did the same.
Here we go. Okay. Take a look at number 39. Most of the time, they just want you to figure out the ratio.
Are we gonna take this tomorrow with you?
If we have enough time.
Okay.
No, is it normally with 10 hours or 9.5, 10 hours? We probably don't have a lot of time, but we will. But does anyone know? Can anyone answer this? Based on what I told you, if I didn't totally ruin it. So what's par? What's par? And you divide it by the convertible price. No, it's the other way around. So it's 2 to 1. So the ratio is like the second number doesn't mean a whole lot. Okay. So it's going to go. You do 100 divided by 50. That gives you 2. That means for every bond you convert, you get 2. So it's 2 to 1. That's your ratio. Okay. I think that's how they're going to look on the test. Okay. Any questions on that? So before, let's talk about this now. So why do I buy convertibles? You buy it for income, right? You buy convertibles for income. That's literally the only reason you do it. You're buying it for that quarterly income. Now, the risks of owning preferred, let's talk about that. If you buy a preferred, you're getting 6% every year. Well, rates go up and down. So if rates go up, your preferred looks less attractive. Because if you buy a 6% preferred and rates go to 8, all the new preferreds are 8, where yours are paying 6. Yours is less attractive, so it will drop in price. That's interest rate risk. Inflation risk is the fact that prices go up, yet you're getting the same amount of money every single time. Okay. Third, the third risk is reinvestment risk. Now let's think about that for a second. So if I'm getting 6%, okay? If I'm getting 6% a year, every year, and rates drop, what am I going to do with the money that I'm getting, right? So if I have any kind of fixed income has this that pays. So if I buy, $1,000 worth of 6% preferreds, that means I'm getting paid $60 every year. What am I supposed to do with this money when I get it? Spend it or reinvest it, right? But what if the rates now, what if the rates have dropped to like 4%? That means any new money you get off of this is going to be reinvested at 4% versus the original 6%. So you're actually making less money, right? So reinvestment risk is the fact that you're getting paid and the money you got, you have to reinvest at a lower rate. That's reinvestment risk. Call risk, and it's only zero coupons do not have reinvestment risk. Maybe write that down. Zero coupons do not have reinvestment risk because there's nothing to reinvest. Third, fourth, whatever it is, call risk. As interest rates drop, okay, as interest rates drop, your bond will go up, which is great because that becomes a premium bond. But the issuer is like, wow, I'm paying 6%. I could pay 4% instead. So they're gonna call the bond, which means call the bond or preferred, buy it back from you, and then reissue at a lower rate. So that's the risk of being called, is a risk that the issuer will call back the preferred or bond stutter. Okay, so the next one is, again, I love Shark Tank. If you go to Shark Tank and you watch what Mr. Wonderful always goes, let's do debt. Let's do debt instead of equity. This way you're not giving up ownership. Because the biggest fear of like the founder is losing control. Like you see, I don't know if you see it all the time, but you do see it when a founder starts a company and then they kind of go public, and next thing you know, they lose ownership and boom, they're gone. Like the founders are gone and they lost the whole reason for making the company and everything. So that's one thing that Zuckerberg did. It was smart, like him or not. What he did was, and this should show up in the test. He has what they call super voting shares. Super voting shares are shares that have more than one vote. So like technically, Zuckerberg owns 38% of Meta, but he has 64% or something like that of the total voting shares, of the votes. So he can never, ever, ever be outvoted. Because he has once you have more than 50%, you can pretty much do whatever you want. So that's his deal. So he owns 38% of the company. Okay. And he owns 30% of the company, but he has 60% of the vote. So he can vote it. That's what they call a super voting share. Could be on the test. Okay. But let's not go there. So let's say he doesn't want to give up ownership. He or she doesn't want to give up ownership. So they decide, you know what? I'm going to borrow the money instead. I'm not going to give up equity. I'm going to borrow it. And that's what Mr. Wonderful does. Kevin, I forget the last name. He will lend the money to the issuer. So the issuer, when they issue a bond, they're actually borrowing money from the investors. So remember, the issuer is borrowing money from the investors. Okay, now, if we have, my family's about to start blowing up my phone, and I don't want that happening. So now, if I'm going to borrow it, so what happens is a bond, we know already that you issue it under a trust indenture, which means it's a trustee like a bank or somebody, making sure that the issuer, the evil issuer, doesn't screw over the people who lent them the money. So again, it's you lending me money. I'm the issuer, my tax tutoring, I'm using it to raise money. You're going to lend me $1,000. I'm going to borrow the $1,000, and then I'm going to pay you back in 30 years. I'm going to pay you your $1,000 back in 30 years. So once that happens, okay, so I'm going to pay you back in 30 years, and then you go, wait, how does that work for me? So I'm going to pay you a little bit of interest every single year. So if, in case, let's say we have a picture in front of us. Oh, why don't I just change this? So it's $1,000 bond. You lend me $1,000. We'll say it matures in 2044. So that means you're going to lend me $1,000. I'm going to give you back your $1,000 in 2044. but during the time I'm going to pay you $60 or $30 every 6 months, $60 every year until 2044. So that's good. You make $60 every year, so you make back 6% on your stuff. That's awesome. Now remember, like if you were to lend me personally money, whenever you lend the money to a friend, you want it back as quick as possible. Whenever you lend money to a company, you want it to last as long as possible. So there we go. Now, so we have 2044, you're going to get it back, $60 a year in payments, we're good to go. Now, the indenture is going to list all the things like I talked about before. Our biggest risk is default risk. So we can either have a secured bond, which means it's backed by a product. That means if I fail to pay you, we will sell that product, whether it's a property, a collateral, equipment, whatever it is, and pay off the shareholder, the bondholder. And then whatever's left over, you hope that it's enough to cover it. So a secured bond has some assets backing it that if we default, they'll sell that. The trustee will sell that to pay you. An unsecured bond or a debenture is just, hey, I promised to pay you. It's a full faith and credit bond. I just promised to give you the money. That's all we're doing. Okay. So now, it's a full faith and credit bond. It's called a debenture. It's higher risk. So which do you think would have a higher coupon? A full faith and credit bond, right? A bond that is debenture or one that is secured? Which do you think would have a higher coupon? The debenture, right? Why? Because it's riskier, right? I love it. Awesome. Okay. Because it's riskier. That's all it is. Okay. Now, if I issue that, I'm going to pay you 6% a year every year. Now, what happens if rates go up? What happens to the price of my bond? It goes down. Why does it go down? Because it's worth less. Because it's paying less, right? So the price of the bond will drop. If the rates go up, that means you're still getting 6%, but the new bonds are only paying, the new bonds are paying 8, you're only getting 6. So the price of your bond will drop because it's less attractive. What if the interest rates drop? What's going to happen to the price of your bond? They're going to go up because it's more attractive. Because if you have a 6% bond paying $60 a year, and the new rates are now, I don't know, 3%, yours are going to look a lot better than those 3%ers. So they're going to go up in price. Now, here's a way to recognize, this is going to help you a little bit. Probably all have some version of it. I think you guys know how to do the seesaw, but I do a triangle. It's a little different. But I mean, it's the same idea. So if you think the triangle will screw you up, please close your eyes and don't look at the screen. Okay, now, so we have discount bonds. We have premium bonds on the right. There's 4 yields we worry about. Coupon, current, yield to maturity, yield to call. Stretch it out. Those are our 4 yields from left to right. Coupon, current, yield to maturity, yield to call. So down here is the par bond. Down here is a par bond, okay? So that means a bond at par, all yields are the same. Easy. They're the same. But if I have a discount bond, coupon's going to be lowest. And since it's lower than par, and we'll go over how to do this, the current yield is going to be a little bit higher. The yield to maturity is going to be higher than that. And the yield to call is going to be the highest. Now remember something. You will not have to ever, under penalty of death, ever have to calculate these 2 things, ever. Now, on the premium side, and I'll go through the math in a second for the current yield. Coupon's highest, then current, then yield to maturity, and yield to call. Okay. Okay. Now, that is something you want to write down. If you don't have a cheat sheet or a triangle already or a seesaw, you want to write that down. 100% you want to write that shit down. Now, let's go over a little math here. I'm going to leave this up so we can do it. So, if you buy par bond, $1,000 par, 6% bond at $9.50. So the way we're going to have to figure out, we know the coupon. So the coupon is a stated rate, is a nominal. That doesn't change. That's the 6%. But we're getting 60 bucks. Even though we only paid $9.50 for the bond, we're still getting 60 bucks every single year. Okay, let me move that out of the way so it doesn't look so crazy. So we have a 6% bond, we bought it for $9.50. So how do we do current yield? We have to figure out that $60 divided by what we paid. So we're going to do 60 divided by $9.50. And the way I remember that is currents have amps, amp, annual over market price. So let's find out the yield. What's the current yield on this one? Can anyone figure that out? So we're going to do 60 divided by $9.50. It's literally just annual over market price.
6.3%.
Let's see if that's right. Probably right. 60 divided by $9.50 is a grand total of 6.31. So that's your current yield. That's what you're earning on the price you paid, because you're getting 60 bucks and you're making 6.31. And again, you will not have to figure out the math on these two. Just know that they're higher than. So let's try another bond. Let's do the same thing. Again, annual over market price. Let's say it's a 7% bond, and the bond is trading at. So we're going to do 7 divided by 70 divided by 1250 equals. Did anyone get 5.6%? Did anyone not get that? That's 100% of the people in this room got it. Okay, I love it. That's awesome. So that's current yield. So now understand. So if we have a coupon on a premium bond of 7%, and the current yield is 5.6 because it's a premium, that means the yield to maturity is going to be even lower than that, and the yield to call is going to be even lower than that. Now, if they ask you what rate you quote, if it's a discount bond, you always quote yield to maturity. If it's a premium bond, you quote yield to call. That's always what they call yield to worst. And if it's a par, it's always yield to maturity. It's always the worst yield possible. You never do current yield, you never do coupon. You can say, oh, the 6% bond's trading at whatever the yield to maturity is. You cannot say, oh, it's a 6% bond and stop right there. You have to give some sort of price. We okay with that?
You gotta ask the test.
What? Okay. I'll show you questions in a second on this, right? So this will absolutely they will absolutely ask you, they could ask you, what's it going to be quoted at? And if it's a discount, it's yield to maturity, and if it's a premium, yield to call. That is absolutely testable. Now, before I move on, there's sometimes you got to use the chart to recognize it. If I buy, remember the first number you see is always the coupon. So if I buy an 8% coupon bond, at 6%, is that a premium or discount? Using this thing, using this chart, Can anyone figure out whether it's a premium? And if you can't get it, I'll do it. I'm just trying to see if you guys can figure it out.
I mean, discount.
So let's match this up. Is the coupon higher or lower than the current yield, or whatever yield it is? The first number is always the coupon. The second number is the yield. So is this higher than this?
Here.
Which one of these is the coupon higher than the other yields?
Okay, premium.
Right. So if the yield is lower than the coupon, it is a premium bond. If the yield is higher than the coupon, it is a discount. I'll show you current yields in a question. I just want to get through the rest of the bonds first, and then I'll come back and do them, because one of them is going to be a treasury, and you kind of need to understand that before we do it. So is everyone kind of okay with this so far?
Yes. Yeah.
Okay. If not, tell me. Okay. So corporate bonds are issued by corporations. Now, one thing to remember, the interest on them is fully taxable. Remember that. The interest on corporate bonds is fully taxable, which means you're paying ordinary income rates on all of them. Okay. Now, what if I'm a rich person? If I were a rich man, so if I was a rich person, what would I do? What are rich people worried about?
Tax.
Yes, taxes. So what kind of bond could I buy that would be okay for that? Would be good for a rich person? How about a muni bond? Okay. So muni bonds are bonds issued by cities and states. And what's very cool about them, and boring at the same time, is there's no federal taxes. And if you live in like the great state of Texas, you don't pay any taxes on it because you don't pay income taxes, state taxes. So if you buy a muni bond, even from another state, you in Texas will pay no taxes on it. Now, if you're in a regular state, like another state, you might have to pay taxes on it. Like if I live in Jersey, and I do, and I buy a Pennsylvania bond, I won't pay federal, but I will pay state. However, if I'm in New Jersey and I buy a New Jersey bond, I will not pay any taxes. So but the reason people buy muni bonds is because it's tax-free income. So rich people buy munis, poor people buy corporates. That's what I thought. Rich people buy munis, poor people buy corporates. This is, if you're poor, look, 40% of U.S. households pay no taxes, okay? So that means most people do not make enough to justify munis. So if I knew that I wasn't paying taxes, I'll buy corporates all day long because I don't care about the tax part of it. I'm not paying taxes. Now, there are two types of munis. There's GO and revenue. GO bonds are for stuff that is free to use, like a high school, a library, not a convention, a community center, a park that you walk through, maybe local roads. Those are all free to use, and they're paid by, the reason I was 2 minutes late is because I was walking through they were repaving my entire road and I had to park half a mile. So, because I couldn't get out otherwise. So GOs are for stuff that is free to use. Now, where do they get the money to pay those taxes? Remember, they pay the interest, right? I almost said the interest. They remember when you issue a bond, so if a GO, city, town, state, Dallas, Irving, whatever it is, issues a bond, they have to pay the interest to the bondholders. So where do they get the money from to pay the interest? Taxes, right? What they call ad valorem taxes. So ad valorem taxes are property taxes. That's where they get the money. So GO bonds get money from property taxes. Okay. Now, so what does that mean? So it means if they issue a bond, doesn't that mean your taxes might go up? So don't you think they should get your permission first? So write this down. It's recorded anyway. GO bonds need voter approval. Before you issue a GO bond, you absolutely need voter approval. And then you also they have debt limits. What are those? Debt limits are the amount of bond, the total dollar amount of bonds that a town can issue at any one time. It's like the debt ceiling you hear about in the federal government. You can't issue more than the debt. You got to vote it in. That's what happens. So the debt limit is how much you can borrow at any one time. And if you hit the debt limit, you have to either pay some of it off or not borrow the money. And third, the money has to be used intrastate, INTRA, not inter. So GeoBond money can never, ever, ever, ever cross state lines. So even if you're way up in the top of Texas and you want to Oklahoma, right? So and you want to do a joint thing with Oklahoma, you cannot. Okay. Okay. That works. So that's a GO bond. It's backed by taxes, free to use. It's, again, everything that has to do with it is all about the population and the taxes and stuff like that. Now, a revenue bond is for stuff that costs money, okay? A revenue bond is for stuff that costs money. So, like, do you guys have toll roads at all or no?
Yeah.
Okay. So they're not free, obviously. So, like, that you'd have to pay for. Maybe a bridge you have to pay a toll on. Or a building, maybe they have a government building or something where you have to pay to, like a museum or something like that. A convention center that costs money, an airport, a hospital. Those are all things that generate revenue. So revenue bonds are to issue things that generate revenue. Before you issue it, you have to do a feasibility study. Actually, people use it. Like I don't know the airport's closest, right? But if you're going to Dallas, Fort Worth, they may have a long line in there, right? There may be 2-hour waits every time. And you're like, wow, we really could use another airport. So they will do a feasibility study to decide if there's enough demand for another airport or you're just whiny, okay? So if it's enough demand, they will do it. Like in New York City, I think we have 3. Yeah, I know we have 3. We have 3, and I think they're trying to add a 4th up in Westchester, a little north of the city. But they're doing a feasibility study to decide, is there going to be enough traffic for that airport to justify opening it? Because it's billions and billions of dollars. So we'll see what happens. But again, an airport seems free, but it's not because you're paying the tickets to fly. Okay, so before I issue a revenue bond, I have to get a feasibility study. Doesn't matter by who. And a legal opinion. This is what you have to know. A legal opinion is bond counsel. It's done by bond counsel. Legal opinion says whether there are issues or not. It's weird to hear this, but you want an unqualified opinion. An unqualified legal opinion means there's no problems. A qualified legal opinion, that means it's stuff we have to fix. Okay. So again, before we issue the revenue bond, I need a feasibility study. Will it work? And a legal opinion. Is everything legal? Then once we issue it, boom, we're good. And we use the revenues from the project to pay for the interest. That's that. Okay. Now, the thing about revenue bonds is there's no, just say the other one, it's the opposite. No voting. You can cross state lines, and there's no such thing as a debt limit. Okay, because it's just literally, if you're bringing enough revenue to cover the debt service, you're fine. It's the second you're paying out more in interest than you're bringing in, that's when people have a problem. So revenue bonds are bringing in more than hopefully they're bringing in more than they charge, so it'll work. Now, there's another thing called a moral obligation, which is literally just a revenue bond. There are other things called muni notes. These are like very short. Just know that muni notes, a lot of them are money markets. They're short-term muni bonds. They're normally made for like when we need money really quickly. Okay, now we go into what the WIMPs buy. Treasuries. So I try to remember this. I always say it over and over again. Bills, notes, bonds, tips, and strips. I'm going to write it down, so don't worry about that. Bills, notes, bonds, tips, and strips. Bills, notes, bonds, tips, and strips. T-bills. These are under a year. Zero coupon. There's no time to pay, so they pay at the end. That's what a zero coupon is. They're considered the risk-free rate of return, and usually do it to park. If you have a short-term time horizon, you have a house to buy in 6 months or so, that's the way to go. Notes and bonds are very similar. The difference is, this is 2 to 10 years. 11 to 30 years. Now that's the differences. Now we're talking about the similarities. They both are what they call term bonds, which they pay to the end, but they pay semi-annual. Term semi-annual, and they're traded in 30 seconds. Which is just like, why? It's just because they're so busy. They have
32.
Yep, at 32. So I'm going to show you how to do it. So let's say you have a bond.
130 seconds. 230.
Only T-bills trade in 30 seconds. Okay. So let's say you buy a bond at 98-20 or 98.20. Okay, so 98-20 versus 98.20 is literally the same thing. So the first step is you do the 20 divided by 32. Everyone do that on your calculator. 20 divided by 32. I'll do it. 20 divided by 32 is 0.65. You'll get that?
Yeah.
Okay. Then you just 0.65, and then on the calculator add in the full price, the 98. Not the 98.20, just the 98. So just on the calculator do plus 98. Do you get 98.625? I'm going to make sure people get it. Remember, the screen is small, so if you're nodding, I can't hear it. Okay, so now. So I'm going to try a new one just to make sure we're good. 101.25. Can anyone tell me how much I paid for that one? First step is 25 divided by 32.
Well, yeah,
So I'm going to get 25 divided by 32 is 0.782125. And then I'm going to add the 101 to it. 101.78. Did anyone put an extra zero in there by mistake? Yes? That's why I say do it on the calculator. Just do 25 divided by 32. Don't write anything down. Then just do plus 1. Does anyone not get that?
Yeah. Multiplying by 100.
We're going to do more. I will do these in a second. Now, tips, you just got to know that they're still treasuries, but they adjust for inflation. Just for okay. So that's so if you're worried about inflation, you're gonna buy a tips. Because remember these. So do you think these have very high coupons or very low coupons? Low because they're super safe. Okay. And then strips are just long-term zero coupons. Long-term zero. Okay. Those are the treasuries. Now remember the taxes on that. So let's go through it. Corporates are fully taxable. Munis taxed on the state level, not the federal. And treasury bonds are taxed on the federal level, not the state. Remember that. So I always tell people entities tax themselves. Start with this one. Coupon over its annual market price. We're going to do 8.5 divided by 1,020. Did anyone get an answer?
8.33.
There you go. Love it. Does anyone not see how we got that?
Don't you need to do 85 to like that?
Well, it doesn't matter really. Because you're still going to get the same numbers, right? So if I do 85 divided by 1,020, I get 0.083, right? So if I do 8.5, I get 0.0083. It's all the same shit. But you're right. I mean, you're right. That's the way to do it. But you don't want to waste time on this.
Yeah, you just give me a flip back.
I'm going to do 7.5 divided by 98-25. But ooh, it's a decimal or dash. I got to do something. So I got to do 25 divided by 32. That equals 0.781. And now on the calculator, I'm going to do this, right? I'm not going to do this in my head or write it down. Do 98. Sometimes you lose track. 7.5 divided by 98.781 equals. Did anyone else get 7.59?
Yes.
We all got that. Love it. See, let's keep moving. We got more current yield to do. There's a couple that look different. Okay, everyone do that one. Number 67. You okay? Okay. So it's 25, 30 seconds. Does anyone have an answer? B, easy stuff, right? Good. Okay. These are gimme questions on the test. Okay. Number 19, it's a little different. So it's stock current yield Okay. So first, remember, it's annual over market price. So first thing we have to do is 75 times 4. 0.75 times 4. That's going to be $3 divided by the market price, divided by 75 equals 4%. Did everyone get that?
Mhm.
Anyone not get that? I know it's a little different. Did somebody say they're missing it? See, it's funny when I don't know how I come across to you, but it comes across very bubbly, and I try to guess what you guys are saying.
One more time.
Oh, there you go. That's I heard. I love it. Okay. So now, so remember, it's annual over market price. So whoever yelled at, what's my dividend?
75 quarterly.
75 cents, and that's quarterly, which means I'm getting paid that 4 times. So do 4 times 75 cents. Then you're going to divide that by $75. Then I do $4 or $3 divided by 75. That should give me 4%. Is everyone okay with that? Okay. Let me see if I have any. That might be it. Okay, this one, you got to find it in the words, baby. And then, guys, when you get bored, I have a video called SIE Math. It's literally just an hour, almost 2 hours, maybe, of me maybe an hour of me just doing math. I would slow it down. I got speedy at the end, but it's literally like 20 current yield questions in a row, 20 stock parity. It's like a lot of good stuff in there. And the whole goal is to get it so often that you can't get them wrong. So here we go. I'll stop talking for 30 seconds. Now, all I'm going to do since it's preferred. Oh, hold on. Did anyone get an answer?
Yeah.
Did everyone get A? Does anyone not get how I got A?
Yep.
Okay. I think that's my last turn.
Go back to it? Yeah.
Go back to it?
Yes.
Sure, that'd be fine. I have no problem reviewing it. Here we go. So now, they asked what is the current yield if the preferred is trading at 62. So what's my preferred coupon?
5.
Then I'm going to divide it by 62.
5.
Everything else is just distracted. What's my current yield if the stock is trading at 62? 5 divided by 62. There it is. Okay. That's literally how they would ask on that. Okay. So now, let's talk about this for a second. Oh, you know what? I got a good sheet. I have a good thing I'm going to bring up. It's a good sheet about the risks of the different securities. So before you leave, take a picture of this when I scan it. Just do it. I swear it'll help. I know you're leaving. I respect that. Just take a picture of this. I'm going to explain it. I'm just going to go through this will solve a lot of problems on the test. Okay. So we're going to go through this. And once you read it, you're like, oh, okay, it makes sense. I even did a video. So now, look, it's all about the risks of the different products. So if I have a corporate bond, look, if I'm going to trade in eighths, okay, munis trade in eighths. What does that mean, Ken? That means that if I buy a 98 and an eighth bond, see, that's a 98 and an eighth. That's how it's going to look. So you would do the same thing. You would do 1 divided by 8. That give you 0.125. and then you'd add the 98 to the front of it. That's how it'd be quoted, and then if you want to make how much it is, 98.25. So that's what I'm saying. They're just corporates and munis are eighth. As one of this guy Tommy, I was friends with him from the stock exchange, but he was a student of mine for a little bit. The way he always remembered this was he always said it to himself, corporate eighths. It worked for him. Okay, so again, if you see an eighth or any kind of actual fraction, an eighth, 3/8, a quarter, a half, all that stuff, it has to be a corporate or a muni. If you see it, these are 1/32. If you see a decimal or a dash, like if you see 98.25, it is absolutely a treasury. Okay. Let's follow the bouncing ball. So corporate bond, it definitely has default risk, definitely has interest rate risk, reinvestment risk, call risk, inflation, no legislative risk, which we'll get to. Now, how do I measure default risk? We didn't talk about that. How do I measure default risk? Like, how would a normal retail grandma or grandpa know where to look to find the default risk of a corporation?
The credit rating?
Yep. Now, what's the highest credit rating? AAA, right? So we have A, B. That big gap is the difference between speculative and speculative and investment grade. I mean, A, B, A. Same thing. So I always say Moody's is different because he's Moody. Okay? So these are the normal ones. These are Moody's. Again, everything above, triple B above is investment grade. Anything below it is speculative. Good. Now we're back to this. Credit risk, interest rate risk, reinvestment, call risk, inflation. If we have immunity, we have all the same risks except for legislative, that they're afraid they're going to change the tax code and maybe make muni bonds less tax efficient or less tax free. So that would be a risk. That's legislative risk. Now, if we go look at all the treasuries, what risk do they not have? None of them have default risk. As they joke around, if one of these treasuries defaults, well, getting your money back is the least of your problems. Okay? You're going to be hiding in a basement with a gun sticking up there waiting for people to attack you. Okay, so T-bonds, they have interest rate risk, reinvestment risk, and inflation risk. They do not have call risk. Treasuries don't get called. They don't have legislative, and they do not have default risk. A strip is a long-term zero coupon. So it doesn't have credit risk. It has a lot of reinvestment. It has a lot of interest rate risk. Interest rate risk is volatility too. So the long-term bonds have more volatility than short-term bonds. Low coupon has more volatility than medium or high. So I would say long and low, unless you've heard that. Long and low, baby. That means long-term bonds move more than short-term bonds, and low coupon moves more than high coupon. So zero coupon is a deep, deep discount bond. So it obviously is very, very, very volatile. No reinvestment risk is nothing to reinvest. No call risk, it does have inflation risk, more so than corporates because it's a lower yield. Tips, no call risk, no inflation risk, because literally Treasury inflation protection security, it is absolutely protecting against inflation. So it does have interest rate risk, but less than other ones because it moves with inflation, and reinvestment risk it has. T-bills, it's all empty. That's called the risk-free rate of return. You ever know the risk-free rate of return? It's treasuries. Now, preferred stock, even though it's stock, acts like a bond. So it has default risk, interest rate risk, reinvestment, call risk, inflation risk, and I think that works. Okay. I'm not going to add anything to that. There's no legislative risk. Now let's jump to the common stock. Common stock has none of these. So remember that. These is a wall. They don't cross over. If you see common stock, it doesn't have default or interest rate or reinvestment, call risk, or any of these things. Common stock has systematic, which is market risk, and you cannot diversify that away. And it has non-systematic or business risk, which you can diversify away by buying mutual funds, ETFs, stuff like that. Then ADRs, and it doesn't have political currency risk because it's in the same country. ADRs are foreign securities trading here. So they have both the systematic, non-systematic, and political currency risk. They have them all. Good. Any questions on this so far? It's a good thing to just memorize. Okay. Yeah, it's not something you'd write down on your hot sheet because you never finish it, but it's good to get an idea and just kind of go over and over and over. Okay. Now, that's most of we have one more product to talk about. Then we can talk about mutual funds and stuff. Okay. How do we feel about options? An option, okay, an option is a piece of paper that gives you the right to do something. So let's say I want to buy milk. And milk is at $4 a gallon, but I'm worried that it's, I don't know, maybe it's a commodity. I'm afraid that the price will go up. So I go, look, I'm willing to spend like 30 cents for the right to buy milk at $3 a gallon. So let's put it up. I want to buy milk is at $3. I don't even know what it is, but say milk is at $4. They just went with inflation. So let's say I'm afraid it's going to go up, but I don't want to buy milk yet. I don't need it. I have enough milk. So I'm going to buy the right to buy milk at $4. So maybe I'll pay like 10 cents. Okay. So I'm paying 10 cents for that right. That means no matter how high the milk goes, I get to buy it at what price? $4, right? So if the milk is at, milk goes up to 10, I'm a happy camper because I get to buy it at 4, even though it's trading at 10. Now I have two choices. I can just exercise it and buy the milk, or I can go, you know what? I still don't need the milk, but I'm gonna buy I'm gonna sell the thing. So now, in reality, if I have the right to buy milk at 4 and the milk is at 10, how much is that option worth? What do we think it's worth?
6.
Yep. Yes. Because right now you can buy it at 4, it sells at 10, you can make $6. By the way, that's called intrinsic value. The in-the-money amount, the amount it's worth, is called intrinsic value. Now I could exercise it at 4, buy the milk at 4, and then drink it, or I can buy the milk at 4, sell the milk somewhere else for $10. I can do whatever I want. But in reality, if it went like this way, and I didn't want to buy the milk, I would just sell the right to someone else who's probably willing to pay close to $6 for it. I make my money and I move on. So that's options are all along that line. So now we're going to go a little deeper. Okay. So now you guys make your options box maybe a little bit different, but I'm going to go with mine for now because I can't accommodate every little iteration, but it works. Understand how this works. If you buy a call, this box works for you. That means if you buy a call, you have the right. You didn't own it. You don't own anything. You have the right to buy stock at a price. So let's say it's $50. You have the right to buy the stock at $50, no matter how high it goes. You're not obligated in anything. If you decide later, you don't want to buy it, and you just want to sell the option, have at it. Go for it. So you have the right to buy stock at 50. So let's make up a number. So you have the right to buy 100 shares at the strike price of 50. Doesn't matter the premium right now. Now, if you exercise that, it means you're going to get to buy it at 50. So let's say the stock goes up to 60. You could easily you could probably sell it for 10 or 12 bucks. Let's say you can't. Buy the stock at 50. could sell it at 60 and make $10 because I would exercise my 50 call, buy the stock, buy the stock and then sell it when it's trading up at 60 and make $10 minus the premium. Now, the question is, if it's trading, I'm going to walk for a second. If it's trading at $60 and you have the right to buy it at 50, who the heck is going to sell to at 50 when they could sell it at 60? Why, yes, only someone that would have to. So the only someone that would have to is the person who sold the call. This person. They took on that obligation. They said, don't worry about this. If you want to buy the stock at 50, go ahead. I'll sell it to you. So let's pretend you guys bought it. Okay. Having one stock, having bought it, you have the right to buy it at 50. I am obligated to sell it at 50 to you if you tell me to. I am the other side of the contract. You paid me whatever the premium was, $3, $4, whatever it is, to have that right. So I took that money from you and I have it. If the stock moves, hopefully it'll move down and I hope it'll expire. But since it went up to 60, I'm not happy because since I have to sell it to you at 50, I don't own it yet. So I have to go up and buy it at 60 and then turn around and sell it to you at 50. I lose $10. Okay. As a buyer of the call, I want it to go up to forever because I want it to keep going and I can make more and more money every time. Because remember, I don't have to exercise the option to make money. I can just sell the option for where it moved to, the extra profit, and keep it. But in this case, I bought this. I have the right to buy it at 50. It's trading at 60. I'm going to exercise, which means I exercise, which means this person gets assigned. That person gets assigned. And then I will have to go buy it at 60, sell it to you at 50. I lose $10 minus the premium. Okay. Are we okay with that? Anyone need me to go over that again? Okay. Now, if I buy a call, I have unlimited gain potential. Stock go up forever, but the only thing I can lose is the premium. Because let's say the stock does go down. Say the stock goes down to like 30. And I have the right to buy it at 50. Am I going to exercise that option? If I have the right to buy it at 50 and it's trading at 30, am I going to exercise the option or let it die? You're going to let it die. Because why would I buy stock at 50 when it's trading at 30, right? So if the stock dropped to 30 and you have the right to buy it at 50, wouldn't you rather buy it at 30 than 50? So you buy it at 30 and let it expire. Now, I'm happy because you paid me for that. Whenever you sell an option, you want it to expire. You don't want to use it. You want it to expire. Okay. So now, let's see. So we have, okay, that works. So if it goes to 30, now let's think about this. So why would I sell you this call? What's the reasoning behind, other than craziness, why I would sell you this 50 call? Because I can have unlimited loss potential here. What's the purpose of selling options? Selling options in general. Just so you're going to make the premium, right? Looking for income, that's it. So the way I explain it this one. So if everyone here has iPhones maybe, and you all buy Apple Care, why does Apple run Apple Care? Well, it's not because they love you and they want to take care of you. It's they know that they write these contracts, they get $200 from you. They know that 80% of these contracts expire worthless, so they keep the money. That's why people sell options. 80% of options expire out of the money. Which means 80% of the time that you sell an option, you're going to make money. Now, when you lose, you could lose a whopper. But for the most part, you're pretty much 80, 85% of the time, If you sell options, you're going to make it. Okay. Now, when you buy a call, let's say you buy an ABC 50 call at 4. And we'll say the other side is sell on. That's our obligations. This is our buy contract. This is the sell one. So now, if I have the right to buy stock at 50, and I just say the stock goes to 50. If it goes to 51, I can buy the stock at 50, immediately sell it at 51, make $1, but I spent 4, so I lose 3. It goes to 53. Buy the stock at 50, sell it at 53, make 3, but oh, I spent 4. So if it goes, I lose $1. Now, if it goes to 54, buy the stock at 50, sell it at 54, I make 4. But I spent 4, break even. Now, so the break even is going to be strike plus premium, because if it goes to 54, I break even. Anything above 54 is a gain. Anything below 54 is a loss. Okay, now, on the sell side, I have the same break even. Okay. So, if the stock goes to 53, I will have to go, since it'll be exercised, I have to buy the stock at 53, sell it at 50, I lose $3, but I have 4, so I make $1. If it goes to 54, I have to buy the stock at 54, sell it at 50, I'm going to lose 4, but I have 4, that's my break even. Let me make it a little more. Let's say the stock goes to 57. Since it's going to be exercised, since I have to sell stock, I'm going to buy the stock at 57, sell it at 50, lose 7, but I have 4, so I still lose 3. Does everyone kind of get that? Does anyone not get that? What happens if this, I don't know if everyone's been quiet because you're like, what is he talking about, that idiot? Or they're all getting it now. If the stock's trading at 48, that means the owner of the option would definitely not use it. They would let it expire. So in that case, I would win the total. I want the option to expire. But again, the risk here is that the most I can make is that premium I'm getting, and the max loss is pretty massive. Okay. Now a put, it's the same darn thing, except for it's the right to sell versus the right to buy. Again, same thing except for it's the right to sell versus the right to buy. So I have the right to sell 100 shares at the strike price. I'm going to buy IBM 50 put at 3. So I have the right to sell 100 shares at 50, and I paid $3. The other side of this option, I'm going to sell 3. So I took in 1. Now remember, if I buy a put, bearish. So I want it to go down. If I sell a put, I'm bullish. I want it to go up. Now, if the stock goes to say the stock goes to 45. Where do you guys have the right to sell the stock? Okay. I'm going to just do it. So if it's trading at 45, you have the right to sell it at 50, and then you can just buy it at 45. You would make $5. Can everyone see that? Am I losing people on the puts?
No.
Okay. So if it goes to 45, I can buy it at 45 and immediately sell it at 50 and make $5. But how much did I spend? So I only make 2. You okay with that? What if the stock goes to 47? Right. I can buy it at 47 and then immediately sell it at 50, make $3. But I spend 3, boom, break even. Okay. Now, on the sell side, remember the other side of this is that. So if it does go to 45, this person has to sell the stock at 45 or going to buy the stock at 50 and then immediately sell it at 45 and lose $5. But they got 3, so they lose 2. Now let's say the stock goes to 52. Is the buyer of the put going to exercise their option?
No.
Right, so they're going to let it expire. So they're going to lose the 3, and the IBM over here, the IBM put is going to expire, and you're going to keep the money. Let me try one more. What if the stock went to 42? Can anyone tell me what I would make or lose if it went to 42? And walk me through it.
Big 5.
Did it make how much? Okay, walk me through how.
You buy it at 42, sell it at 50, that's A, but you get 3 shares at 85.
Yeah. Yeah. So now I'll do it in a different way, but you nailed it, dead on. So if it goes to 42, since you have the right to sell it at 50, you can buy it at 42, sell it at 50, make 8, but you spent 3, so you only make 5. This could have done the same thing the other way and just lost. Now, remember something. If it's a call, intrinsic is, if you see the word intrinsic in the money, and a call is anything above the strike price, and a put it's anything below. So I have a kind of way of doing this.
Yes, you're correct. No, that's
Market price is, market price here is out of the money, and 0 intrinsic. Now remember, intrinsic, and in the money and out of the money mean the same thing. So here we go. So now we got this one. Let's say if the market price is here, it's in the money and has intrinsic. So what I do when they ask about a call or put, and they could ask it, I just cover the other one. So if they're talking about calls, I do this. If the market price is above the strike, it's in the money. The market price is below the strike, it's out of them. If they ask about puts, it's a little. I just cover the call and higher. If it's market price is above the strike, it's out of the money. And if it's below the strike, it's in them. Out of the money, in them. Okay. I don't know if that helps. It should help a little bit because you're saying, look, if I'll show you a question or two. So now let's do a couple questions to see how we do. We're gonna do questions on multiple things on the products. Okay, we're gonna do a lot of the products and options and stuff like that. Just so you can see what they look like. Okay. Now let's see what you've read and we can talk about it. Look at number 1.
See.
So let's go through each thing, okay? So what do we think it is? I mean, I'll give you a second to read it. Do we all think what do we think it is? Okay, so it's actually A as an apple. So let's go through it. A euro dollar bond is when like Apple or Tesla or some American company issues a bond in another country, but it pays in U.S. currency. That's a euro dollar bond. It doesn't even have to be Europe. It just has to be not the U.S. A euro dollar is U.S. money deposited in a foreign bank. So a euro dollar is U.S. money deposited in a foreign bank. An ADR is a foreign security trading here, and a banker's acceptance is for foreign trade. It's actually kind of cool. So if I'm a Japanese exporter and you're a San Francisco importer, I'm agreeing to send you $20 million worth of cars. And you're going to send me $20 million for those cars, but we don't trust each other. So I'm not sending them cars until you send the money, and you're not going to send the money until I send the cars. So we're kind of in a stand, okay? I'm worried about that. So what we're going to do is you're the importer. You're going to take your $20 million and put it in a bank with my name on it. And it says, Ken, you will get this $20 million when the cars show up. I now feel safe sending the cars. So that's what I do. So that's called a banker's acceptance, when you take money that you owe me for finance, for a merchandise trade, and you put it into a bank account and it's earmarked for me. It's like a time draft. It'll say, oh, the money's freed up when the cars show up in the dock. Okay. So everyone can see my screen, I think, right? If you buy a call, that's just a long call. You have unlimited gain, and you can only lose your premium. When you buy a put, you can only lose your premium, but you can make a lot of money down to zero. However, on the sell side, your losses are big. If you have this selling a call by itself is called an uncovered call. It has unlimited risk, and the most you can make is the premium. This selling a put, this naked put, yes, you can make the premium, but you can lose as much as you break even. So if you sell at 50, put at 2, you can lose $4,800 for the $2. But remember, a naked put has unlimited risk. A naked call has unlimited risk. A naked put has a lot of risk. When you buy options, you don't have a lot of risk. The reason I said that is, we'll go back to the next question. Can you see my new screen? Can you see the questions again?
Yeah.
Okay, good. It's on the same tab. That's right. Okay, good. Okay. Now look at number 2. So can we agree that it's A?
Yeah.
Uncovered call are the riskiest. Remember, there's unlimited risk with an uncovered call, right? Look. Unlimited risk. Uncovered call. Imagine putting something with unlimited risk in your pension. I don't think people would be very happy with that. Okay. Number 9.
Yeah.
So does everyone agree that it's letter D? Because cumulative preferred, remember, so let's talk about it. Cumulative preferred means even if you miss the old dividends, you still owe it. So you cannot pay the common until you pay the old dividends. Participating has none of that. Participating just means you get a bigger dividend for that quarter. That's all. So again, D is in David, because if you own cumulative preferred, you're going to miss dividends for all the years, not just this year. Number 11, see if you can figure this one out. A, baby, A. Banker's acceptance is always for foreign trade. Commercial paper is just short-term debt. Now, we can write this down. Commercial paper is unsecured, short-term, meaning 270 days or less, debt, corporate debt. And since it's under 270, it's exempt from registration. The SEC is not going to bother themselves with something that only lasts, 9 months or so. So again, commercial paper is unsecured short-term debt that's 270 days or less. Repos are just when the Federal Reserve is trying to goose the economy, they're going to buy treasuries from the banks and then sell them back. Then, so what happens is the broker, they're going to buy treasuries from the bank, and the bank is going to sell them to them with the promise to repurchase them in a day or two at a little bit different price. Okay. Here we go. Number 13. Hopefully you can remember what I said. So put option, let's see. Put option, anything below the strike price is in the money on a put, anything above the strike price is in the money on a call. So call up, put down. So the answer has to be A. Okay, so the answer is A as an apple. Because if you have a 50 put, anything below 50 is in the money, anything above is out of the money. If you have a 50 call, anything above the 50 is in the money, anything below is out of the money.
Yeah.
I think we did this one already. 19.
Go, Henry.
Wait if everyone a chance to think about it for a second. Okay. An ADR represents what? Yes. The answer is B. It represents a foreign security held in a foreign branch of a U.S. bank. Absolutely. So it's basically like Nestle stock held in a branch, British Petroleum, whatever it is, Nestle stock owned by Deutsche Bank. Deutsche Bank has a branch in Switzerland or whatever, buys the shares of Nestle, packages them, and sells the package in the U.S. I love it. Number 22. Okay. So how do we think it's
C?
who thinks it's D? How many people think it's B? A? C? Nobody's willing to change. Okay. So the answer is D. So convert. So to understand, so if participating was here, I would think about it, but convertible is the better answer because remember, since if you have a convertible bond and say I have a thing that if I have a bond that turns into 2 shares of common, if I have a bond that turns into 2 shares of common, it will always be double the amount. It'll always trade twice as much as the common. So if the common goes to 50, this will go to 100. Common goes to 60, this will go to 120. Common goes to 30, it'll go to 60. It moves with it. So as the earnings of the company go up and down, the stock goes up and down. So then the convertible will move with it. So convertibles are almost 9 times out of 10, it's the answer. Like if you truly can't pick an answer and convertibles there, take it. It's right more than it isn't. But
So how does that relate to the interest rate again? When you said the lower interest rate and then setting lower?
Well, just the lower interest isn't really a big deal. It's more about the fact that, so let's think about it. Well, it's not a real part of it, but it does make sense. If you have a choice of a regular preferred or a convertible preferred, which would you rather take?
Convertible.
So since that's more attractive, I don't have to pay you as much. So like I can do that. So if I'm going to issue a preferred at 8%, and I go, God, I don't want to do that. So maybe I'll secure it. Maybe that lowers it. Maybe I'll make it convertible. That'll lower it. I can try all these different things to make it more attractive. And convertible is one of the things that do that. Okay. And again, like my big thing is convertibles are the most volatile because they match with the stock too, stock price. Okay. Try 23. So if you own stock, this is the thing, stock index options are options on the indexes. Okay, you may not have read about them, but we do know that they're based on stocks. Okay, so look at this. If you work it out, what if you remember my chart? Is credit risk a bond risk or a stock risk? So tap. Is inflation a bond risk or a stock risk? What about interest rate risk? That's a bond risk also, because stocks don't pay interest. So boom, there it is, market risk. So you could have not, when they talk about stock, you got to match up the risks with the not. If they said preferred, you deal with that. Oh, 32. So treasuries, do we agree that it's D as in David?
Yes.
Good. Easy stuff. Those are easy ones you cannot give up. Okay. I didn't talk about it, but let's talk about it. What's a money market? Short term, right? Okay. Hit it. Number 34. Do we agree that it's D? D as in David, right? Because look, and when I took this, I was like, I have no freaking idea what a Fannie Mae discount note is, right? I don't know. It's just a short-term Fannie Mae thing. But I knew that this is 30 years, so it can't be a money market. Good. Well, here we go. This is not suitability, it's just recognition. So you know, 2 to 10 years, we agree? Let's go through each one. It's painful, but let's go through it. T-bill is under a year, and it doesn't pay interest till the end, so that's out. Tips, they didn't mention inflation, so that's out. And strips, it's not long, it's a long-term zero coupon. Again, strips and T-bills are out because they pay a coupon. Good. Okay, see if we can get 41. Okay. So the answer is C as in Charlie. Because remember, long and low. Long-term bonds move more than short-term bonds. Low coupon moves more than par premium. Boom. Oh, we talked about this. 43, baby. I'm just trying to do stuff we covered today. So what do we think? So they can sell to everyone, but so 144A, remember I did it real quick. 144A allows you to sell to who? QIBs, right? So QIBs are qualified institutional buyers. Those are institutions with over 100 million under management. So I would say that an accredited does not fall into that world. And I think you guys are answering it. But again, it doesn't say, it's hard to tell. Cool. So the answer is C as in Charlie, because it's an individual. QIBs are always corporations, money, financial institutions. Here we go. 47. Everyone do the math.
B.
Yes. Because now the next question is, what should the new share price be? Does everyone if everyone didn't do it now. How would you find out the share price?
Divided by 3.
Yep. 21 divided by 3. Before I move on, does anyone not get this? This is easy, low-hanging fruit once you get it. We got to make sure you get it, though. Is anyone not comfortable with this? 51. So which bonds move the most, no matter what? Now, I don't see long and low. I don't see any of that shit. But we also know convertibles move like a MFR. They go like crazy because they move with the market. Now, I'm going to say one thing. If you see variable rate or adjustable rate, adjustable rate do not have interest rate risk. They do not move because they adjust with it. They adjust with the interest rate. So the market price will never move. So convertible is the answer. I'm just telling you, if you see variable rate or adjustable rate, they have no interest rate risk. They're the most stable price-wise. 53, similar idea. Okay, so I'm looking for the most, I do not want volatility. So I'm going to try to find the one that has the least volatility. So long term has the most volatility. So that means short term has the least. Right. So what's the answer? D is in David, baby. Does everyone get that? This is always tricky for some people. Does everyone get why D is the answer? Because it's the shortest term. Okay.
D is the shortest term? Yeah.
So least volatility is the shortest term because it's only 1 year. If I wanted most volatility, I'd probably do this or this. Okay. Ooh, this is a wordy one. Just not wordy, but it's worded. It's an easy question, but it's worded crazy. So here, let's go through each thing. So T-bills. Now remember something. Here's a rule I have. The shorter something is, the safer it is, the more liquid it has. Okay. So the shorter something is, the safer it is, the more liquid it is. So T-bills are super short, super safe. So they're super liquidy. So A is not a thing because it's very liquid. T-bills, they don't pay a coupon. It's a zero coupon. They pay at the end. Does it have credit risk? Not really. T-bills are literally called the risk-free rate of return, which means there's no credit risk. And then the last one is a fixed coupon. It does not have a fixed coupon because it is called a zero coupon. Boom. Everyone okay with that? I don't want to move on. It's a tricky one. Like, I think hopefully most of you got it. You all got D out of it? Because it does a fixed coupon is like a 4% bond, a 5% bond. This is a zero coupon. T-bills do not have a coupon. 58. Okay. Now 58. Remember, so if I get a rights offering, that's when they issue more shares. So yes, I can buy more shares for a discount. So A is a true statement. Can I sell them if I want to? Sure. So B is a true statement. Can I let them expire? Is it moronic? Yes, but I can let them expire. That's giving money away. So that's fine. Then the last one, it's not to increase proportionate share. It's to maintain it. Okay. So the answer is D as in David. Okay, thanks a lot. That was the 3-hour class on the podcast. A very, very high level, not super deep on a lot of the products and stuff for the SIE exam. We didn't do order types. That's the next one maybe. But I have videos for that. I'm hoping you're enjoying this. And don't forget to like, subscribe, and share this shit.